All right. Thank you, everybody. Bringing to you. This is part 3 of a 5 geared towards the buy and hold investor. In part 1, we covered how to analyze any buy and hold deal. In part 2, we taught you how to find a diamond in the rough or a killer deal. And this might be the most important one, because what good does part 1? So in this part, I've brought 2 great speakers to talk about the multiple ways to finance an investment property. My name is Vala Shahabi. I am founder of 52 Properties. Started 52 Properties. We've been dealing with clients all throughout the country, helping them family homes, all the way to duplexes to large multifamily properties. And we come across a lot of deals, and we just figured, hey, why not start a site where we can just shoot off the deals that we come across that we think are great. So the concept of the site is one off-market deal each week, and that's what we do when you sign up for our newsletter. Now, the first speaker today is Kevin Amolsch. He's from Pine Financial Group. Kevin is a private lender and knows that area inside. I think you guys are going to be in here for a treat for what he is going to reveal. And then also followed by him will be Loren Whitney from New Direction IRA. Loren is my IRA go-to guy. So any questions that come up for 401k or IRA or how to we're going to start off with Kevin first. So Kevin, I'm going to go ahead and give you controls. And whenever you're ready, go ahead and push right.
Oh, fun. Fantastic, Vala. Thank you so much for having me. I want to start by saying the phone was cutting in and out a little bit while I was listening to you. So if it does that, let me know and we'll try to figure that out. But otherwise, I'm just going to plow forward here. Like Vala said, my name is Kevin Amolsch. I'm the founder of Pine Financial, and I'm so excited to be here. Pine Financial is the leading hard money lender in Colorado and in Minnesota. Before I started raising and lending private money, I was actually buying a lot of rental properties. I got started when I was really young. Bought my first house when I was 20 years old, and bought my first investment property when I was 22. It was interesting because I was in the Army, and I generated some income. I generated income that I wasn't using, and I bought a property. I moved into it when I got out of the Army, and then I had the GI Bill paying me. And I joined the National Guard for a little while. See, it's cool. It's the National Guard paid for my school when I was going to college, and I had the GI Bill help me out with my other bills. So I didn't really need student loans, but heck, I went out and got a student loan anyways because I could borrow money at 1% interest, tax deductible, use that student loan money for a down payment to buy my second house, which I moved into, and I had my first investment property. So that's kind of how I got started in the no money down rental property acquisition game. I was a broke college kid, okay, and I was buying 1 to 2 houses a month. And when I say broke, I'm not kidding. All college kids are probably, but I didn't have too much help from the folks, so I was eating lots of top ramen trying to get this thing going. Right now, I have 55 rental units, 55 doors that I own. So I went right through the crash and came out and started buying like crazy in 2008. I've got everything from a bunch of single families, some small multis, up to a 23-unit building. What I'm going to be talking about today is how to finance rental properties, and I want to make sure it's clear for everyone that's listening that this is a quick overview of lots of different ways that you could finance properties. So I'm not going to get into a whole lot of detail because, heck, I just don't have enough time for that, but this will at least give you an idea of ways that you can do it. And at the end of my short presentation here, I do want to give everyone a free gift, so I'm going to go ahead and do that. Now, Val, I actually see you typing some stuff in here, so I don't think I have control anymore.
Oh, no, okay.
The first thing we're going to look at here is a graph, and I wanted to start with this graph because it really shows you how great rental property is and why financing rental property is such a powerful strategy. I still don't have controls here, but it looks like I did get to the graph. What you're looking at is different types of investments, several different asset classes over the last 25 years, what that would have done starting with $100,000. And you could see everything from an annuity, which is probably your most safe, most consistent, how it doesn't turn into a whole lot in 25 years. And then as you go up this, or actually down here through private lending and purchasing properties with financing, private lending is actually a really good investment because it's a high, steady return without the work, but nothing beats buying real estate with leverage. So if you had the $100,000, you put $25,000 down on 4 different properties, you could see how well that would have done over the last 25 years. Okay, here's quickly what we're going to talk about. Cash or lines of credit, conventional loans, portfolio loans, private money, which I've done a lot of. Hard money refinance is a pretty cool strategy to pick up properties with little or no money down. And then finally, partners. All right, cash and lines of credit. Lines of credit can be lots of different things. It could be secured or unsecured, like a home equity line of credit on a primary or a rental property. Unsecured lines of credits could be credit cards, or a lot of times you'll get lines of credit attached to checking accounts. You can also have business secured or business unsecured lines of credit. Once you start getting into the business lines of credit, it gets a little bit more expensive. So what we're talking about here mostly is going to be like the home equity line of credit. So using cash or home equity lines of credit is going to be your highest profit per deal. And that's, when I say profit, it's not overall profit. What I'm really talking about here and what I look at in rental properties is cash flow. So on a monthly basis, per property, highest cash flow when it's cash or lines of credit. The next one is the lowest return on your investment. So without leverage, like we saw in the graph, it's not going to be a huge return on your investment. You are going to be limited because your capacity is limited. Except for the U.S. government, I don't know anything else that money is not finite. I mean, if you keep buying, you will run out. So using cash is going to really limit what you're able to accomplish. And it can be risky. I mean, you have lazy diligence. You don't have an appraiser looking over your shoulder, an underwriter looking over your shoulder, a mentor, someone helping you make sure you're making good decisions if you're just out there throwing your cash around. You're not diversified, again, because of your limited capacity. So up to litigation. I was actually quoted in a national paper because I'm so passionate about people paying off their homes and their investment properties. You know, there's attorneys out there that get paid on a contingent fee. And what that means is they only make money if they sue somebody and they're actually able to collect. So the first thing these attorneys do before they even take a case and decide to sue you is look to see if you have any assets. Nothing screams that you have money more than real estate being recorded at the county with no liability, no debt. So free and clear property opens yourself up to litigation. And finally, you may get better deals because you can close much faster than anybody else. Okay, conventional loans. This is going to be more of the Fannie Mae, Freddie Mac type of loan. So you go out to a Bank of America or Wells Fargo, let's say, to get a loan. 20-25% down payment kind of thing. Those loans almost always are sold to Fannie Mae or Freddie Mac, which is basically sold to the government. Okay, I really like these types of loans because they're cheap. In fact, they're probably the cheapest with the best terms that you can get out there. These are 30-year fixed-rate loans with interest rates in the 4 to 5% range on investment properties. So it's dirt cheap, almost free. You are going to be somewhat limited. You're going to be limited both on the size of the loans and on the number you can do. I think this is probably a good time to explain lender overlay. If you're out there doing deals and you're working with mortgage brokers or a bank, you might hear the term where you might hear, you can't do more than 4 finance properties. I'm not going to let you buy more than 4. That is a lender overlay. Fannie Mae will actually allow you to go all the way to 10 finance properties. So if you hear that you're restricted to 4, you know that that's not true, and you need to find a new lender that sells. Conventional loans can be extremely hard to qualify for, especially if you're self-employed and you're not reporting a lot of income. One of the biggest qualifiers for conventional loans is your debt-to-income ratios. But they're going to qualify credit and cash reserves and all that as well. The property has to be habitable. For it to be habitable, it needs to have a kitchen with a place to cook food. It needs to have conforming bedrooms. There's other qualifications for habitability. But I'll tell you what, I financed as a private lender a deal that another conventional lender could not finance because there was no conforming bedrooms. And the reason there was no conforming bedrooms is because there was no closet. For those of you that are out there doing deals, you know that you could frame and drywall a closet for about $400, maybe $500 if you want to pay a little bit too much. So for $400 or $500 fix, they couldn't get a conventional loan. And conventional loans will not fund repairs. So if you're buying turnkey properties like you can do with 52 properties, conventional loans might be a fantastic way to go because they're no rehab, they're ready to go. You just put your down payment down, you get your best terms out there. But if the property needs rehab, conventional loans might not be the best because they won't finance your repairs for you. All right, moving on to portfolio loans. Portfolio loan is any lender that keeps their loan in their own portfolio. So banks, the small community banks that don't sell to Fannie and Freddie. Okay. The cool thing about banks is they're going to be much more flexible. They're not stuck to the little box that Fannie Mae puts you in. So the big one is you're not going to be limited to the number of properties. We have relationships with banks here in Colorado that will loan 30, 40 properties to one person. Obviously, there has to be a strong borrower for that, but that is possible. A little bit risky terms. When you get into the conventional or the portfolio world, we're not talking about 30-year fixed loans anymore. We're on the commercial side. Even though it's a residential property, it's still considered a commercial loan. So now we're talking about 3, 5, maybe 7-year term loans. Term just means that at the end of that term, you have to pay back the loan, get it refinanced, sell the house, something. They're extremely slow. It's not uncommon to see a 6 to 8 week close with portfolio loans. The reason this is true is they have to go through an approval process, get approved just like a conventional loan, but then it has an extra step. It has to go through a committee approval. A committee might meet once a week, maybe once every other week, depending on the size of the bank. So you could be waiting for this committee to even look at your deal. Relationships are extremely important. This isn't LendingTree. You're not going to get online and get a loan. It's important to know who you're doing business with. They want a relationship, both personal and banking, so that means they're going to ask for deposits a lot of times. But that's good. You want that. You want a relationship with a small community bank, and if they have a little party, you go out and that party, and you get to know those bankers because they're the ones that really help you go to the next level. It is more expensive. You're going to have higher interest rates. Usually the points and the fees are similar to a conventional loan, but your interest rates are going to be a little bit higher. And then finally, it's a great supplement to your conventional loans. I really think you should max out your conventional loans first and then go into the portfolio world. If you can qualify conventionally, do it. All right, private money. I've done over 200 or close to $200 million in private money business. We have access to over $46 million right now that we use to loan out to our clients. So I know a little something about private money. There's a couple different ways that couple different categories, I guess, you're going to consider private money. The first one is owner financing. When I was that broke college kid doing all those deals, this is exactly what I was doing. I was getting the owner to finance me. That can include lease options. That could include subject to transactions. Subject to is simply just taking title to the property, but not, how do I explain this real simple? It's taking title to the house without taking any responsibility for the loan, but you got to keep making the payments on the loan. So you're taking over the payments. I know that's a complicated subject, but just understand that you're getting title to the property and using the current loan that's in place. Contract for deed is not that. It is very similar to a subject to. There's a little bit more protections for the seller, but it's going to be similar. A wraparound mortgage is very similar to both of those, if you've heard of that. Other types of owner carry could include like a owner carrying a second position to help you with a down payment requirement maybe. If the property's free and clear, they could simply give you title and make you sign a note and a mortgage or a deed of trust. So any of those could be owner financing. And I really think if you're getting started and you don't have a lot of money, owner financing is a fantastic way to go. The downside to it, of course, is it takes a lot of work because you have to go out and find the leads. You got to go out and negotiate with these owners. All right, I don't have control again, so there it goes. Third-party private finance. This is basically borrowing from your friends, your family, anyone else who has some cash. So your grandma, grandpa, you go to those networking meetings and you pass out your card that says, I want to borrow money, that kind of thing. So anybody willing to give you money. It could be IRAs, which I think we're going to learn quite a bit about, and you got one of the best speakers on the subject here tonight. Private money is extremely, extremely flexible. It's whatever you guys negotiate. So it can be cheap or it could be very expensive. Balloons are common. Most private lenders want their money back sooner than later so that they feel more secure in the deal. So I oftentimes offer shorter terms to them to get them to accept my deal. And it's not easy to do. I've turned private money into an entire business where I spend 40 or 50 hours a week doing it. And that's how I've been able to raise so much money. Someone that's doing this part-time or more focused on out there finding deals might not be as good at raising private money because it is hard and it takes time and effort. Okay, hard money. The way this works is a hard money is basically a bridge loan to an end. It's a means to an end. Hard money is always short-term, so you're not going to use this to actually carry or hold rental properties, but it is a good way to acquire. So let's talk about that. It is going to be the most expensive way for you to do it, but it's very flexible and it's fast. And here's what makes it awesome. This is why people pay those crazy hard money rates, the points and the fees and the interest. It's high leverage. You can borrow money if you find a good hard money lender that knows what they're doing. You could borrow 100% of your deal, all of your purchase, all your repairs, all of closing costs, everything. So it's true no money down financing for investors. And because it's such high leverage, it's the highest return on your investment, and it allows you to do multiple deals. And multiple deals is how you generate tremendous cash flow. I'll tell you what, I got 55 properties. I've got a couple that don't do so well, but I really like the first part of the month. All right, here's how the hard money refinance works. So you got to find a bargain property that needs some rehab in a good rental area. When I say good rental area, what I'm talking about is a good price to rent amount, a good price to rent ratio. Oftentimes that's in the lower income areas, and it needs to be rehabbed. You need to add value to it to justify a big sharp increase in value. So if there's not a lot of rehab, like a paint and carpet kind of thing, it's probably not going to fit for this strategy. You want new kitchen, new bathrooms. If you could do a little addition or finish a basement, that kind of thing is really what we're looking for. Okay, you could purchase it with hard money and make the repairs with the hard money loan. Hopefully, if it's a good enough deal, borrowing all of the money to do that. Go out and find your tenant and get that property producing some income. And then you refinance it into a conventional loan. And then you just do it over and over and over and over. There's several reasons this strategy works. The first one is the hard money lenders, a lot of them, will loan of the value. Fannie Mae, the conventional loans, will loan 75% of the value. So you can get that refinance done without any closing costs. All the closing costs can be rolled into the loan, so you won't have any more out of pocket. And there's a little bit of a buffer there in case there's a difference in appraised value from what you and your hard money lender think it's worth to the appraised value of when you refinance it with the lender that's going to sell the Fannie Mae. Okay, there's no title seasoning with Fannie Mae. Oftentimes with banks there are, so this works much better with conventional loans. You can literally refinance a property 2 weeks after you own it using the new appraised value if you go direct to Fannie. Now, remember I talked about the lender overlays. A lot of lenders are going to tell you you need to own it for 6 months or 12 months before you could refinance it if you want to use that new appraised value. And I'm here to tell you that's simply not true. Fannie Mae has no title seasoning requirements, so if you hear a 6-month or a 12-month seasoning requirement, that is a lender overlay, and you need to go to another lender that doesn't have that overlay. Okay, it must be a good value, and you must, like we talked about, you must rehab it for this whole thing to work. Okay, partners. Fantastic. In fact, several of my properties I was able to acquire with partners, and then I later bought them out. But credit partners is really the best way to go. When you get shut off, let's call it that, with Fannie Mae loans, those are the best loans to get, like we talked about. And if you're planning to hold these loans for 30 years, you want a Fannie Mae loan. So it's possible to bring in another borrower, to team up with them, have them get the loan, and then you guys are a team on that deal, and you can you can buy another 10 properties potentially if it's a good credit partner using their financial strength and credit. Maybe you need cash partners. Maybe you need help with down payments and reserves and repairs. So you could bring in partners to help produce the cash that you need. If you don't have a lot of time, I partner with a lot of people because I don't have time. We're developing I don't even know what the number is, but it's over 50 townhome units in a sweetheart neighborhood in Denver where I'm not doing any work at all. I'm just providing money, someone else is developing it, and we're gonna make a killing doing it that way. And it's because they have the time and I don't. Experience. So if someone's got the experience and you don't, or vice versa, it's a good reason to partner with people. Access to deals is another great reason to partner. If someone's out there finding deals, but they can't take them down, and you can. If they don't want to wholesale them, maybe you partner with them. And there's many, many more. Some of the reasons partnerships work, or the main reason partnerships work, is when two different people or more are adding different types of value. Where you get into trouble is when two people bring the same value. That's when there's going to be conflict. I've got some friends that have partners that are other friends, and I see them struggle through it. And I've seen partnerships and friendships destroyed just because they're partnering, because they're buddies. So I know that that's a reason that people partner, and that's not a great way to go. So if you add value, they add value, it could work. And one last thing I want to say about partners is partners, I think, are essential to reach your potential. There's, like I said, there's finite amount of cash that you have. There's finite amount of time. There's finite experience. All of that is limited. It's unlimited when you can work with partners, but just be very careful. Okay, so I went pretty quick through this, so I left some time for questions if there are any, but I want to end here with this free gift. The hard money refinance strategy, that's nothing new, although I call it the new way to buy rentals right there. It's really not. I say that because people like that. But let's face it, people aren't doing it, and it's such a sweet strategy. So we wrote this free report that I'm going to give you. Several pages, 9 or 10 pages, walks you exactly through how the whole process works with case studies and everything. So there's the gift. Go to pinefinancialgroup.com. And with that, Vala, if there's any questions, I'd be happy to take them.
Thank you so much, Kevin. That was awesome, and thank you for the gift. I think a deep dive into some of the concepts you talked about is really helpful, especially with the use cases. To the audience, if you have any questions, go ahead and type it into the little chat box there, the second one from the left. And Kevin can take it right now, or we can take the questions at the end. If there's any pressing questions, I don't see anything coming in right now. So what we'll do is we'll keep going forward. Again, Kevin, thank you very much for your time. That was awesome.
Thank
you. Great overview, and I'm sure if anyone has any questions for you directly, they can. Contact info was on that second slide, so the slides will be distributed as well after the webinar. We will take questions at the end. If anything pops up in your head, go ahead and type it in that box, and then we'll shift over here to Loren. New Direction IRA. Loren, I'm going to go ahead and give you mouse and keyboard controls. So go ahead and see if you can, yeah, looks like you can move the mouse around. So go ahead, Loren. Thank you.
Sure, no problem. Thanks. Well, again, Vala, thanks for having me, and it's really great to be able to get on here and talk about retirement plans. And it's always tough to follow Kevin on presentations. You know, he has such great information about financing and ways to go about it. And I mean, let's face it, the retirement plan side of things is a little bit more dry than that. But what I'll talk about tonight covers some kind of new ideas and things that many people haven't thought of before. And so that's where you can kind of go into the creative financing side of saying, okay, if I may not have enough money or credit in my own pocket, maybe I have a retirement plan that I can go to, or even in raising private money, looking at IRAs as a vehicle for that as well can be really fantastic. And it's kind of funny, I see my name there. My name is Loren Whitney, not Loren Whiney like it shows there on the screen. I've been here with New Direction for going on my fourth year here, and I'm the Assistant Director of Business Development, which really means I oversee all of our inside sales and education, essentially helping any new person that comes through the door get acclimated, get educated, make sure they have all of the accurate and correct information as they get started, and really just get their foot through the door so they can have success with using the retirement plan and those funds they already have access to invest in alternative assets. And so what we do here is we specifically provide retirement plans so that folks can go outside of the stock market and utilize those plans for alternative investments. And so what that really looks like is opening up a retirement plan with us, just like you would with Schwab or Fidelity or Vanguard. And in doing that, you'd be able to invest those funds in whatever it is you want to outside of the stock market, because we provide all of the record keeping for things like real estate or private loans or private equity, even precious metals. And so anyways, that's some of my contact information there on the screen if you want to jot that down. The one thing I will say is that I do have to start with just a short formal disclaimer because of the business that we're in, and that's just really that we don't provide any investment advice, nor do we provide investments. And so tonight's information is just for educational purposes only. All right, so let's get started. I'm not sure if there's a delay there, if I just don't have control. Oh, there we go. And so one of the big questions that I get from everybody is, you know, what is this idea? What is a self-directed IRA? And it's confusing because a lot of the big brokerage houses out there, Schwab, Fidelity, those guys, they even offer self-directed IRAs themselves. And the thing that you should know is that it's really a descriptive term, not a legal distinction. And so if you have a traditional IRA or a Roth IRA or even a 401k plan, those are the types of plans that are offered. And a self-directed plan is really just one that allows you to make the decisions and control the outcome of what you want to use those dollars to invest in versus putting them into, say a select offering of mutual funds. And that's kind of where you're limited when you use traditional brokerage houses. And so if you kind of picture all of the things that people invest in the world, most people don't realize that they can actually use those retirement funds that they have set aside with all of the great tax advantages that go along with that. And so that's what we'll be talking a little bit about tonight. There we go. And so some of the types of plans that we offer here at New Direction IRA are essentially the types of retirement plans you'll find anywhere else, traditional and Roth IRAs. We have opportunities for self-employed individuals, things that follow a SEP IRA, simple IRA. Even the really powerful individual 401k plan is a great option for folks that want to and even be their own trustee. And then, interestingly enough, folks are starting to self-direct their health savings accounts because of the tax advantages that go along with pre-tax contributions and tax-free distributions, and your ability to really pay those types of health expenses that are qualified out of pocket, and then allow the time value of money and compound growth over time to grow up that portfolio in the HSA so you can withdraw all those funds tax-free later in life if you have some serious or high costs of health care. So anyways, the takeaway from this is that you can take virtually any type of retirement plan now and self-direct it into things like real estate. And so even if you have a 401k plan with a current employer or past employer, you may have opportunities to move those funds as well. a couple important things to kind of kick things off is that an IRA is its own legal entity. And a lot of people that call up and say they want to buy a property have a hard time grasping this. And the concept is really that they think of their IRA as their own money, when in fact they should think of their IRA as a separate person, a separate entity, like you're running an LLC or a corporation. Everything is done under its own name, its own bookkeeping, its own accounts, and it's separate from all of your own personal finances. And as soon as you wrap your head around that, then things become a little bit easier in understanding how your IRA goes out and purchases property. And so with that, you would actually go out and put a contract in, and you would use specific titling. I'll cover that in a second. But your IRA is going out and taking title directly to real estate, or it is being the lender, it is being the borrower. Your IRA can take out financing or even seek out someone like Kevin and utilize hard money in the IRA. And so with that being said, we at New Direction are also the provider for the account, and therefore we're actually the legal signer for the account. And so what we help people with here is reviewing all of the contracts, making sure the titling is correct and the paperwork. We send funds to closing, but we also sign all of the contracts as well. And we work with a lot of great digital technologies like EchoSign, DocuSign, and different types of signing methods to keep everything easy for everyone electronic, so there's not as much faxing and so forth these days taking place. That being said, one of the biggest IRA rules out there, I should say IRS rules really, is that there's this concept of no self-dealing. And this is a really broad overview. I won't go into too much depth tonight because I don't want to take up too much time. But the concept is that you're not allowed to actually benefit yourself by using these dollars for investments today. The whole idea is benefiting later in life tomorrow. And so if you go out and invest, one of the common questions I have is, hey, my son's going off to college. Can I purchase a rental property with my IRA and just rent it to my son or let him live there so I don't have to pay his rent while he's going to school? And unfortunately, that is a self-benefit and self-dealing. And so what that really looks like is there's this list of what are called disqualified persons. And disqualified persons are individuals that can't do any deals across the table from the IRA. And so if you picture a closing table, buyer on one side, IRA on the other, you can really just picture if you have a disqualified person on the opposite side of that table, which is any family member up or down the family tree. That individual cannot buy or sell anything to or from the IRA. They can't rent from the IRA. They can't provide services to the IRA. And so that's where this becomes a very arm's length endeavor, or I should say, an investment structure where delegation and hands-off is important. And I like to tell people it's much like owning property out of state. You're probably not going to fly from the West Coast to the East Coast to handle regular property management. You're going to either get a local team on the ground or pass it off to a property manager. And so with that being said, that's kind of how the whole self-dealing thing works. And so before I get too carried away, let's move on to the next slide. There's several different ways that folks invest in real estate with a retirement plan. One is to just take straight ownership of the property and hold title to it. Another is to partner with other individuals or other IRAs. And so that's just in a simple tenants in common arrangement. You could partner with yourself technically. You can partner with other IRAs, other individuals, other entities. And so the partnership side of things is no big deal. And you can even partner with disqualified persons because there's no actual cash transactions going between parties. Everyone is labeled as their own separate investor. And so if you're going into a deal and you've got a property on the table, have enough money to get into it, you can technically use your IRA as a second partner in your deal. So that's something to consider as you're looking at the overall scenario and what your options look like. In addition to that, you could actually be a private lender with your retirement plan. And so you can lend out money just like a mortgage lender, just like a hard money lender if you can find borrowers. And the great thing about that is you are the one that assumes all of the responsibility and opportunity for assembling your own note, determining what terms you want, screening your borrowers how you please. And so it all lies with you in terms of how you want to handle things. And then your IRA simply sends out funds to the borrower, and the borrower repays your IRA with payments directly here back to our office. So the last part is an entity-related investment. So this is structured in the form of private equity, whereby you're going in and instead of investing directly into a deal, you're investing into shares of, say, an LLC or a corporation or a limited partnership, and you're just taking an by everything is managed neutrally by other third parties, and you're just being a passive investor. And so as your entity buys up, say, an apartment complex or something like that, or a larger deal, you're getting a portion of that share. And so in doing that, you may be able to get into larger deals than you would have been able to if you went after deals personally. Okay, so those are some of the simple structures in which people go through with their IRA. I had mentioned a moment ago there's some specific titling. And so assume you've opened up a self-directed IRA account, you've moved money from let's say an IRA with Vanguard, and now you've got cash in your IRA account here. If you want to go out and put an offer in on a property, the process is exactly the same as if you were pursuing a property personally. The only difference is that instead of labeling the contracts with your name and your address and your phone number, it's actually the name of your IRA, which here would be New Direction IRA Inc., FBO, which stands for the benefit of, and then your full name with IRA on the end of that, or Roth IRA, et cetera. And so you submit your contract. If you want to have earnest money paid, we can pay it right from the IRA balance, and when you instruct us to help you pursue this deal and we sign your contract for you, we can go ahead and have earnest money sent out promptly via check or bank wire, whichever is more pleasant for you. And so that's how you would secure a property under contract with your IRA. Now, you can go ahead and close it. If it's assignable, you could technically wholesale it, and that's how a lot of people I've seen in the past several years grow their IRA accounts quite rapidly as those opportunities are presented to them. And so there's a lot of different ways you can go about it. But at the end of the day, your IRA pays the earnest money, or you can contract a non-disqualified person. And so, again, that's anybody that's not a direct lineal family member, a parent, grandparent, child, grandchild, or any one of those person's spouses. And so brothers and sisters are okay, aunts and uncles, all those good guys, friends are okay. And so if you even get in a pinch and you've opened your IRA account here but it hasn't been funded yet, you could technically get a buddy or another partner to help you out temporarily. Then once the IRA is funded, we can help reimburse that individual. So moving on, the great thing about the retirement plan side of things with regards to alternative assets is the ability to utilize leverage. Now, this is something that's not really well recognized in the brokerage industry. You may have a margin account with a regular brokerage account, but when you go into the IRA side of things, there's some specific rules about personal guarantees, and now margin accounts usually come with personal guarantees. And because there are some financing opportunities in the non-recourse world for IRA accounts, you may be able to leverage your IRA, $150,000 in this example, into a $450,000 purchase value, which is fantastic. And so you can either get into more deals or larger deals. And so if you're pursuing real estate, this is just something to think about. And let's talk about this just a little bit more in my next slide. Well, debt is allowed. And so your IRA, just like I mentioned, the specific titling that goes on the contract, your IRA goes out and fills out a mortgage application just the same. Most of the mortgage lenders will do a little bit of due diligence on you personally, but you're not offering any personal guarantees. And that's why it's called a non-recourse loan. It means that the only thing that's really being held as collateral is the property itself. And so you don't have to worry about the mortgage lender coming after you personally and seizing other assets, other properties, if anything ever were to go upside down. And the big thing about this, too, is that there aren't that many lenders out there that are willing to do it. You'll typically be able to find hard money lenders that are willing to do non-recourse. I know that Kevin does non-recourse to IRA accounts in short term. And you'll typically find other lenders like local and regional banks or credit unions that have those special types of loans. And so the big banks like the Chases and the Wells Fargos and the Bank of Americas won't be getting into these types of loans. And so you can do some research. I have a full list of lenders that we've had clients use over the past. I'd be happy to share that if anyone wants to shoot me an email or give me a phone call and get into that. I will touch lightly on this special tax called the UBIT. And I won't get into too much detail because it can become a pretty complicated subject, but when you use your IRA, typically you'll see down payments of anywhere between 30 and 40% on average, so LTVs of about 60%. And with that, if you're going out and you're financing 50 or 60% of the value of a property, what's going to happen is if you are in a buy and hold situation or you're using your property as a rental, at the end of each year you're going to have to tabulate out what portion of your profits, after all your deductions and depreciation, what portion of your profits were derived from your mortgaged portion or your debt financed portion. And from that, the IRA is actually going to have to file its own little tax return called a 990T form to cover that tax. And so it may sound like a bad thing because you're having to pay tax inside an IRA, which doesn't sound too natural. But the reality is that you were able to go way beyond what you had in purchasing power and get into different assets, more assets, larger assets, that sort of thing. And so the benefit of the leverage usually will always outweigh the UBIT. But, of course, there are some associated risks with that, so that's something to take into consideration. But if anybody is interested in leveraging your IRA account into real estate, let's get in touch later, and I can spend more time with you personally or have someone on my team spend some time with you, and we can cover that in detail. Now, because the IRA is the property owner in this situation, let's say that you have a property in the IRA now, it's being used as a rental, what does the whole cash flow, the cash management side of things look like? Who pays the expenses? Do I do? Do you do? How's that work, right? And so because the IRA is the owner, it's the IRA that is liable for all of the expenses. And so one of the big things in terms of strategy and planning is if you go into a property, you need to make sure that you have far more than enough for just your down payment or just your closing costs. You want to make sure you have a buffer left over to pay all of the foreseen or unforeseen expenses. Maybe you have vacancy, maybe you have repairs, maybe you find out there's a lien on the property after the fact. So all of those things kind of can come into play. So doing your due diligence up front is extremely important in making sure that your deal comes together well. But in the example of a rental, if you have, say, a Joe the Plumber bill or HOA or property management, at New Direction IRA, we're actually a leader in the technology related to this stuff. You can open up your online account and then log into your IRA and pay bills online. So just like you do with normal online banking, you can go in, pull from a drop-down menu which property you want to pay for an expense for, and then put in the payee information and click send. And that's all included in our annual fee. We can administrate any property of any value for $295 a year. And so you can go in there as much as you need to and have expenses paid, and we'll cut the checks the following day because you're actually doing the data entry for us, and we are able to process those types of requests much faster than we used to be able to. So in this example, I kind of just had the clear cut from IRA down to property box without the property manager. You can utilize a property manager, which is great. And so if you're investing out of state or you just simply don't want to play the landlord position, you can always involve a neutral third party to help manage that property for you. And in doing that, they can help with all of the day-to-day management and all of those things, collecting of rent, handling the cash flow. And the nice thing for you is that you just get a dividend or a return on your investment from the property manager back to your IRA every month or every quarter, whatever your positive cash flow looks like. And so that's kind of the fantastic part about that. But it's optional. And so if you want to do the landlording thing and you're investing locally or you've got a system down, we can help you with the technology to make that happen. And as far as rental payments go, your tenants would either send their rental income straight into our office via check, or we've actually now launched some e-check technology that allows folks to go straight online and pay their rent or even note payments straight through our website as well, and there's no costs associated with that. It's all done via ACH now. So that's some other cool stuff that we've got going on. To talk just a little bit more about the management side of things, people ask me all the time, hey, if it's in my IRA, can I be the manager? And the answer is yes, but there are some contingencies. Of course, we're the ones that have to handle all of the cash flow, like I just mentioned a moment ago, but you're allowed to essentially make all of the mental decisions involved. You can hire and fire the contractors. You can interview and screen your tenants and advertise the property. You can technically receive rent and forward it on to New Direction IRA as long as everything is, your checks are titled to the IRA and not to you personally. And then you decide on all of the maintenance, improvements, et cetera. So essentially you're the one that gets to make all of the decisions, put everything in line in order, put all your ducks in a row and keep everything moving forward, but you're not allowed to provide any sweat equity. And for a lot of people, this is difficult to get around because they're so used to doing all of their own property maintenance. But it's one of those costs of doing business with the IRA that you just simply have to get your mind around and really come up with different ways of doing things. And at the end of the day, if you have to pay a few extra contractors to do things in your place, look at what that does to your overall rate of return, compare it to what you're doing now, compare your risk tolerance, decide if you really like real estate, and if so, then potentially the IRA and real estate are a good fit for you. And on the flip side of do-it-yourself property management, you've got the hiring the property management company. And so in this situation, the property manager hires, and you get to decide on the property management company first off, but it's the IRA that hires and pays the property manager. So all of the fees or commissions, et cetera, that come from the day-to-day expenses of the property and their ongoing fees, it's the IRA that writes those checks. So just the same, you'd log in and you would pay online expenses to your property manager, and then positive cash flow would come back the other direction. We at New Direction are the ones that sign all of your agreements. You're the one that approves them, of course, but we're the ones that help put everything in motion from a legality standpoint, so everything done under the IRA structure is protecting all those tax advantages. But at the end of the day, it's the manager that's taking over full control for you and making sure that everything is taken care of. And at the end of the day, we ask that property managers send back some nice detailed reporting and accounting so that we can then enter that information to your online portal so you can see that as well. And so with that being said, timeline involved in this is it can be rapid, it can take a long time. It really depends on what types of retirement plans you have now and who those plans are with. And so it's a very easy process to open up an IRA account. You go on to newdirectionira.com, fill out an online IRA application, and in about 10 or 15 minutes you'll have your account number. And once you have that account number, then you can begin filling transfer or rollover paperwork to move money into your plan. And so I'll just say that every custodian out there, whether it be Schwab or Vanguard or TD Ameritrade or any of those guys, they all work differently with regards to whether or not they require original paperwork, whether or not you have to fill out their paperwork, and whether or not we can fax them paperwork. So there's all these different variables that go into it, as well as what type of plan you have. And so we like to work with everyone, on an individual basis, of course, find out about your scenario, find out where your funds live now, talk about what your timelines look like if you already have any deals identified, and work with you to try and get that expectation set up front so that you can either pursue a deal right away or know that you just simply have to pass up on it because you won't be able to get things in place quick enough. But on average, you'll find that 2 weeks to fund the IRA is typical. You can make new IRA contributions right off the bat in a day or so if you're eligible to make IRA contributions. But the moving of existing funds will usually take anywhere from a week to 4 weeks. Okay, so from there, you'll find your investment. We all know how long that can take. It could be on your plate already. It could be a month from now or longer. You can secure financing, and of course, if you've filled out an application for financing, it'll depend on the lender. It'll depend on their policies and what they need to do in their due diligence factors. And so figuring that out into the equation ahead of time is also a good part of the timeline and to determine your overall closing time frame. Making the offer is quick. It's usually a 1 to 2 day turnaround here on our end. You get paperwork to us. If you get it to us in the morning, we can, in many situations, get it back to you later that afternoon. And then at the end of the day, once we have all of your closing documents, we have 3 business days or less to review that paperwork and get a bank wire out to closing. And so in the big spectrum of things, you can usually get things done in a month to 6 weeks, sometimes less depending on your situation. And so it does depend on what your scenario is. Now, a lot of the key points to just take away from all of this and, why would I use an IRA to get into these types of things is that you probably didn't know that you can go outside of the stock market and invest in alternative assets like real estate and precious metals and private lending and private equity and a lot of other things that people just happen to have personal experience with. I hear about all kinds of unique things that people come through the door with all the time, and it's actually really quite interesting. Aside from that, the tax benefits with an IRA are fantastic. For those of you that are familiar with 1031 exchange and your ability to defer your tax on your investment properties, any capital gains that you have, that is actually built into the IRA structure, whereby if you go out and you buy a property for $100,000 and you pay cash, or you've involved leverage and you paid it off, if you go to sell that property down the road and maybe you sell it for $200,000, that'd be a great deal. In that situation, you have $100,000 worth of a taxable gain if it were applied to you personally. And yeah, you could 1031 that, but with the IRA, it's already built in. It's like buying 500 shares of IBM at $1 today and selling it at $2 tomorrow. With an IRA account, you're not going to have to worry about what the value of your IRA is because you're not paying your taxes until you actually take distributions. And so if you think about this from a tax planning structure, I can't give advice, but in many situations, people like to shift their assets as they get older into cash flowing investments. And so real estate, you can get into a cash flowing investment property that's producing rental income for you. That rental income is actually sheltered from taxation because the income is coming back to your retirement plan and not into your personal pocket, at least yet. And so you're actually the one that gets to choose when you take that distribution, at least until you turn 70 and a half years of age. And so it just gives you some more flexibility in your decision making and the overall big picture of what your financial portfolio looks like. And so that's one of the great tax benefits. You can invest in real estate with a Roth IRA as well and see tax-free distributions. And so that's a really, really powerful vehicle. And so if you don't already know about that, do some investigation, find out if it's right for you. You can always do a traditional to Roth IRA conversion and pay your tax now if that's right for you. And so we can't advise on that, but if you talk with a CPA or a financial planner or you're just savvy enough, do some calculations and run your numbers and see what that's going to do for you and your time span of your retirement account. This is access to money you may or may not have known you had. And in addition to that, there's this funny demographic out there. There's not a lot of industry knowledge out there, industry statistics for what we do because we're such a small portion of the overall retirement industry. And so for those of you that didn't know, retirement plans represent over a $6 trillion market. That's not 401k plans or other accounts. That's just IRAs. And you can move IRA accounts around as much as you want to. And so it's claimed that only 4% of that $6 trillion is invested outside of the stock market. And I can tell you that's true because I hear the same story today that I heard a year ago, 2 years ago, 4 years ago. And that's that I just simply didn't know I could do this. And so whether it be you going after your own personal deals or you're helping other people or you're trying to raise capital, think about IRAs in the back of your head next time you're trying to construct something, and think about what that could do for your next deal and how you can pool some more funds as it relates to those types of plans. And lastly, you're in control, right? I mean, if you're limited to brokerage activity where you're going into stocks, bonds, and mutual funds, that may be fine. You may be pleased with that. But if you want to go outside of the stock market and get into more hard assets and do types of real estate deals that you may already be getting involved in, now you may know you have access to a new pool of funds, and so that's where the power from that comes from. And so with that being said, like Kevin mentioned, he had a free gift to give away at the end of his presentation there, which is great. I think I actually want to get a copy of that myself. But we also have a full list of non-recourse lenders as well as a full transaction guide. It's about 30 pages, and it goes through all of the specifics with regards to how you go through the IRA process, purchase real estate, et cetera. So I'd be happy to provide that to anybody that's interested as well. And so with that, I'll pass that back to you, Vala, if you can still hear me.
Yes, and Loren, thank you. That was fantastic. I think we all learned something there, or if we already didn't know a little bit about investing with IRAs, I think now we know a lot, and now we know who to go to should we have any questions. Again, go ahead and type it in the box. Now would be a good time to ask. So while we have both Kevin and Loren on the phone, we can ask them. If you don't think of what you want to ask right now, or the question pops in your head later, you can always email them directly. Their contact info. That's at info52properties.com, and we'll pass it on. We're going to get into the questions in a second here. Real quick, before we get into the questions, there's 2 more sessions in this 5-part series. The next one is building how to build the proper team so that you can be successful, right? We're going to talk into all the step-by-step, all the teammates you're going to need on this team, from the title, from the property management to the contractors, general contractors, and so forth. And then in session 5 is, okay, now what's next? How can you? So I don't know if anyone wrote any questions. Some people had some issues with audio, but that's because you need to select the audio selector. But Loren, I have 2 presentation. One of them, you mentioned how the property gets purchased with, in the IRA's name and the FBO with your client name. Now, does that have to be in my personal name, or?
Well, Vala, the last part of your question there cut out on the phone, but I think what you're asking is, do you need to have your personal name in the titling? And, technically speaking, you can use your IRA account number instead of your name, which does give you a little bit, of more of a hidden identity, so to speak. But at the same time, the great thing about the IRA is that there's a lot of liability legislation built into the structure, more so with the 401k, but the government wants to protect you from creditors in the event of having to file bankruptcy or anything like that. And so the likelihood of, that there is, I can't speak from a legality standpoint because I'm not an attorney, but I can tell you with a good degree of confidence that there is more liability protection built into the IRA structure as opposed to just you as an individual taking title. And so Hopefully that answers your question.
Yeah, the part that got cut off is, could it be in an LLC?
Oh, it could, certainly. What you'd be doing, just to clarify on that real quick, Paula, you can invest your IRA into an LLC, but your titling wouldn't start with an LLC unless a member. And so that can get a little bit confusing. We'd have to run through a deal, I think, to really clarify that. But your IRA can invest into an LLC, in which the LLC can then go out and purchase real estate.
And when can you start withdrawing? Bought a couple properties through your IRA. When can you start withdrawing?
Yeah, good question. So the withdrawal age with no penalty is 59 and a half. Now, technically, you can withdraw from a retirement plan at any point in time, but if you withdraw before the age of 59 and a half, you're going to have to face ordinary income taxes, which is typical, but you'll also have a 10% penalty on top of that. And so there's definitely some motivators there to wait until you've reached that age. And then, of course, you have tax planning that goes into all of your withdrawals beyond that point.
Great. And I guess if you're already over that age, then it's just whenever you want, right?
Yeah, that's the truth.
Sure.
And the IRS does mandate that you start taking distributions from a pre-tax account at the age of 70 and a half, something called required minimum distributions. And it's really there's calculations that you can do on the IRS website if you're nearing that age. And that allows you to figure out what it is that you're going to be required to take out on an annual basis. But I can tell you that it's typically not a large portion of the plan. It's usually a pretty small percentage on an annual basis.
Awesome. Thank you. Thank you again, Loren. That was very, very helpful. Kevin, are you on?
Yeah, I'm on the phone. I'm having a real hard time hearing you, though, Vala. I don't know if you got any questions for me. Maybe Loren can help us out here and translate for me.
Okay. Sorry about that. I don't know if it's just my connection here. So Kevin, a lot of our clients have cash. They want to buy the property in cash, obviously, to get the best deal, or maybe sometimes they want to use it like a leverage approach. In that situation, what would you recommend they do? What's the best approach to be able to not only secure and buy that property for a good price, but also get their next deal, their next property, and continue that process?
Well, that's a good question, Val. I can start by saying this. Whenever you have leverage, it's a double-edged sword, so there's additional risk using leverage. I'm a big believer in leverage. I think it can really catapult your success, so I think you should use it, both for the higher returns and for the limited liability. Whenever you have cash, whether you're using limited liability companies, corporations, or anything else, insurance, all of that helps protect you. But gosh, it's just a target, so I don't think you should do it. There are strategies to loan yourself money to encumber properties if you want to do it that way. That might be a strategy to walk through with an attorney. But I think you should use leverage whenever possible. So I guess more specifically to get into your question, if you want to use cash, fine, but then refinance that, get the cash out so you can do another one.
Got it. Thank you. Hey, both Loren, Kevin, thank you guys so much for emailing and calling and saying, hey, this is great, but I joined 30 minutes late. I missed the first half or so forth. Guys, this session hopefully was recorded. And once we get that process, we'll put it online and send the link out. So if you missed a little bit of it, you can go back. Probably you want to watch this at least twice through the webinar, that it takes a little while to sink in, maybe once or twice. A lot of things was discussed here. Again, if you have any further questions, you can email myself at info@52properties.com, or feel free to go towards Kevin or Loren directly and really pick their brains and hopefully do some business. Again, thank you everybody for joining us tonight. Thank you again to our wonderful presenters, and look forward to the next session 4, building the proper team. Thank you guys.
Thank you.
All right, thanks, Val. Thanks, Loren.
Take care.